I get asked for my thoughts on the stock market and the future all the time, and I've resisted making videos on it, but I do have an opinion. I thought I would share this. Probably won't surprise a lot of you, but I got some new facts that were interesting to me when I was preparing for this video. So, is the market being irrational right now? We're at or near highs for the S&P 500. Is it time to sell, rebalance, take some gains to miss the drop? What's going on here? So with some background, the S&P 500 PE ratio here in July, price to earnings ratio, is 29.11. Price to earnings is it's a measure of rationality of the stock market. Are these companies making money in line with their prices? The average PE ratio from my research was around 16. So 16 and we're at 29 sounds kind of high. The problem is we have, just to make things a little more complicated, we have 7 tech stocks that are dominating the market performance, calling those the Magnificent Seven, which is an issue called concentration. A lot of the market value is concentrated into a few stocks, in this case 7. NVIDIA, Microsoft, Apple, Amazon, Meta, Alphabet, and Tesla. Together, those 7 stocks make up 29% of the market, of the value of the S&P 500. Microsoft alone is 7.3. That's a lot of concentration. Is this another 1990s dot-com bubble about to burst? I was looking at some PE ratios around at the end of the 1990s. So May 1, 1999, the PE ratio was 34. May 1 of 2000 was 28. 2001 was 28. April 1st of 2002, that was the peak. 46.71 PE ratio, and May 1, 2004 dropped to 21. So those are some relative history points, and you see, hey, we're at 27 right now. Kind of feels like, from a number standpoint, in that 99, 2000, 2001 period, right before the bottom fell out, is this irrational? Is the question that is posed to me. Is this a new era of technology, or is it the same old story of a bubble and bubble to burst? Time to sell or sit on the sidelines? Joe, what do you think? Okay, I'm going to talk about 2 issues. Is there a bubble, and what about market concentration? First of all, market concentration first. I'm going to link a report. I'm not even going to try to summarize this for you. It's a very good report. Again, it'll be the first link you'll come to. It's 2023 data, and they look at the top 1, 3, and 10 companies in different countries. Okay, so they looked at 10 companies, not the Magnificent Seven. So these 10 companies at the time represented 27% of the market. And one of the things that I thought was, a new piece of information for me was, how do other countries compare? And so 27 is the US for these 10 companies in 2023. Switzerland was 60% of their market was from these 10 companies, their 10 companies, top 10. France, 55%. Australia, 45%. Germany, 42%. UK, 40%. Canada, 33%. India, 25%. Japan, 18%. They had a few more countries. These are the ones I noted. But interesting that 27%, the United States is in the lower, 25% of the of these numbers. So I thought that was interesting. The 27 really didn't stick out as like, man, we're very, very unusual here. The report goes into, history of the PE ratio back to 1950. There was a period, I believe it was in 1965, where it was above 30. And again, this looking at the top 10, 27% is the U.S. data. So it's been higher, but you can't argue that it's not a peak right now. But so take a look at that report and see what you think. It definitely is a concentration, but the report really doesn't say that that's going to be a problem. We really just don't know. But it's not an automatic problem like some people say it is. So let's talk about a bubble. And these are, hey folks, these are my opinions. I'm not a professional. But a bubble, what's different from the 90s and this big dot-com bubble that we had with tech stocks? Sounds very similar. But the difference is these companies today, the Magnificent Seven, are highly probable with great products we all use. We all use these products. Back in the late 90s, these companies weren't making money. You put .com behind your name and you had a great idea, you sold it to somebody big, made all kinds of money, and then that all came tumbling down. I remember going through that period and thinking it's like profits don't matter. It's all based on the future growth, this big, we used to call them hockey sticks. Here's a current performance, but boy, next year things are going to take off. It's a hockey stick shaped chart. But these companies today are highly profitable, not just an idea. An example, NVIDIA is the leader in artificial intelligence, hardware and software. They made $30 billion in profit in the last 4 quarters. These guys aren't fooling around. They don't just have ideas. They got solutions in the marketplace. Remember, the market always looks forward. NVIDIA needs to justify their share price. They need to realize a 20% annual growth rate for the next 15 years. 20% year over year. Well, they've done that for the last 15 years. They averaged 21. So they've done it. Now it does get harder as your company gets bigger to increase 20%. Recognize that. But it's not a sure thing, but it's doable. Going back to the iPhone days, what was that, 2007, 4? Heck, I can't remember when the first iPhone came out. But Apple experienced 26.5% growth over the next 15 years. So it wouldn't be without precedent that a significant technology like the smartphone, everybody knows that was significant. AI could be in that same category. Not that everybody's going to have an additional AI device to buy, but companies, businesses, people, your iPhone, whatever smartphone you have, there's going to be an enormous amount of AI incorporated in that. I don't think that's debatable. AI is basically supercomputers and ability to have computers digest mountains of data and learn from that. Okay, the technology is there. So I don't think this time is different. I think this time is the same. Good products that make good revenue and make good profits, they're going to do okay. I don't see this at all like the .com. This is Joe looking at what's happening now and what was going on in the late 90s. I see some similarities, but the businesses are completely different because they're making money, they got products, they're growing, they're established, they're not a hope and a dream. My main question is, when are the other 493 stocks in the S&P 500 going to start pulling their weight and take advantage of some technology or innovation and start pulling their weight? That probably, hopefully, will be will mean a more diverse market and will lower that 27% for the top 10 companies again, if you're getting confused in the number. 27% of the market that's defined by the top 10 that should come down if the other 493 companies get a little larger and do a little better. So what am I doing with all this information? Folks, you know that I protect myself against a downturn. I have buckets 1 and 2 of money, that are really out of the stock market. They're in CDs, T-bills, money market funds, bonds, high yield savings things, and that protects me against the market going down. I have growth in my bucket 3, and those are all stocks. Okay, that's fundamentally where I'm at. I have protection against a downturn, all the drama of the market. There will be another bear market. It happens. I think it's like every 4 years, the market drops by at least 20%. To me, I look at this as I win both ways. You know, if the market goes down, I stay in the market and, get a ride, the gains that the stock market returns over longer time periods. So I get a win when that happens. And if the market goes down, I've got bucket 1 and 2 to live on and keep living my retirement life without high stress and high drama. So yeah, maybe if I would invest in just these magnificent 7 stocks, go 100% all in, things could end up being fantastic for me. Too high risk of a game for me in retirement. I don't recommend that for anybody. That's not the way I play the game. I'm about roughly 80% stocks, 20% alternatives to that, more fixed type income, 20%. And that's pretty aggressive as retirees go. 80-20 is on the high side. You'll see people quote 60-40 portfolios, 50-50, 70-30. I'm leaning in pretty good, but I'm quite a bit more diversified than just the S&P 500. I have some international in there for an example. So questions. Do you agree that the market is rational at a PE ratio of 29, considering all S&P 500 stocks at 29? Is it rational? Do you agree? Do you disagree? Do you agree with my action? Basically, I'm doing nothing, got buckets, I'm protected both ways. Are you taking any action based on your opinion of the market? Let me know in the comments. Joe out.